I don't think there's going to be any problem selling silver to buy gold. You may end up having to buy kilo bars instead of gold. There will be shortages on certain products, but you'll be able to, there will be so many people wanting the silver because of the performance of silver, and you have to be early, not late. I'd rather be years early than a day too late.
If I was convinced that, never mind consolidation phase, this is it, we're in the blow off top phase, and it's going, I don't know, silver's going to triple digits, and gold's going to 5,000-6,000, and if I was convinced that that's what's next, that's what's going to happen in the weeks and months immediately ahead, then the big majors are the top choice.
Silver's accelerating performance is changing the dynamics inside the precious metals market. Even in periods of intense demand, liquidity is unlikely to disappear, though shortages may emerge in specific retail products. As silver continues to outperform, demand naturally broadens, making it easier, not harder, to rotate between metals for those positioned early. In fast-moving cycles, timing the final stages is less critical than securing exposure before momentum turns parabolic. Mike Maloney, a longtime precious metals educator, alongside Lobo Tiggre, outline how this phase could evolve if momentum accelerates further. They note that a scenario in which silver pushes into triple-digit territory, while gold advances toward the $5,000 to $6,000 range, would signal a late-stage expansion rather than a routine consolidation. In that environment, capital would likely flow aggressively into large, liquid mining companies, as investors seek scale, stability, and leverage to rising metal prices. Their emphasis is on preparation rather than prediction. Precious metal bull markets reward early positioning, not perfect timing. As silver demand intensifies and gold continues to reprice higher, flexibility becomes an advantage for those already in the market. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Where if the government tried to borrow too much to do too much deficit spending, they're borrowing gold out of the economy, and that causes interest rates to rise and slows the economy, and that reduces the amount of tax revenues that come in. So it was an automatic balancing system that kept government from getting out of control. And now we've got governments around the world that are just completely out of control. It's like everybody has gone insane. And so we've had these baby steps off of gold, and now we're going to go from nothing back to something in one giant leap. And I believe that there's no way I believe everybody will participate in this. If you do it intentionally and you make plans, you can have wealth transferred toward you. But if you don't, wealth is going to be transferred away from you. There's no way to stand on the sidelines. Somebody asked, could we go into a big inflation without real estate and stocks going through a big deflation? Because they are in hyperbubbles right now. And the answer is yes. It's called a melt up. And the thing that'll be melting up the fastest is the prices of gold and silver. Years ago, I sort of coined the terms, they become unaffordium and unobtainium. First, they become unaffordium. Back in the global financial crisis of 2008, there was a period of time. My first book had just come out. Goldsilver.com was a fairly small dealer back then. I was trying to source gold and silver from anywhere that I could, and there was about 10 days where the only product that I had was kilo bars of gold. I couldn't, all the dealers end up going on allocation. The US Mint can only produce so much, and so I couldn't get gold and silver eagles, and then there was actually 3 days where I couldn't find any gold or silver. I was basically out of business. But before that happens, the price of physical diverges from the spot price, and gold and silver start to become unaffordium. And then, finally, unobtainium. Gold and silver are Giffen goods, where as the price rises, instead of causing less demand, it causes more demand. And gold and silver are the perfect examples of that.
If there was no shortage in London or shipping bars to India and these things going on in the physical market, if that wasn't happening, then it'd be very difficult to interpret this in any way other than we're in the blow-off, we're entering into that blow-off top phase where silver is more than catching up with gold. Even just 2 weeks ago, it was just starting to catch up to gold. It has now, from the bottom, and you don't calculate gains from top to top, you calculate gains from trough to peak. From the last trough in late 2015 to now, silver has now more than caught up with gold. And so if I looked only at price, I'd be very nervous right now. I wouldn't just be taking some profits. I would probably be liquidating positions, going more to cash and preparing to rotate into something else. But since there is an explanation for silver catching up that I think is temporary, it sorts out, and then we go back to trend, which I think is what we started talking about before, a period of consolidation before another move much higher, then I'm comfortable staying long where we are now. Or even if I could find, I'm always buying bullion. That's not what we're talking about when I talk about going long or selling or taking profits. I'm talking about the stocks. If I could find a compelling value proposition in gold or silver, yeah, I would buy that today. Silver obviously has a track record of much more volatility than gold. Absolutely. And that is not a bad thing. Like if you think that the peak has arrived and it's all downhill from here, then you'd want to sell on the bounces, the dead cat bounces along the way down. If you think the opposite, it's consolidating before moving higher, then you'd want to accumulate more on the dips and that volatility. We had, post 2020, I think gold, I'm sure it retreated more than 20% at one point, like there was an official bear at some point, and I don't remember when that was or exactly how low it was. I think we got almost down to minus 30% before the next big move higher. And the thing about, you might say, well, 30%, who cares? It doesn't matter that much. But if you buy at that lower price, it multiplies the upside. Well, let's put it this way. If you bought gold at the top in 2020 and then it rose $100 an ounce, right? So you made $100 per ounce. But if you bought it when it went down $300 an ounce before going up, you made $400 an ounce by buying that dip. So buying the dips isn't just, it's not market timing, it's not just getting cute. It does make a difference to your investment outcomes. The price you pay does matter. I think there's a Warren Buffettism that I can't quote properly. But buying good things at a good price is much more important than trying to worry about the timing. Silver's going to triple digits, and gold's going to 5,000-6,000. And if I was convinced that that's what's next, that's what's going to happen in the weeks and months immediately ahead, then the big majors are the top choice, because that's where Doug Casey used to call these the go-to companies, because that's where the Johnny-come-latelys or the dumb money that's chasing the momentum, that's where they go first. They don't know anything about gold or silver, so they do a Google search for a gold or silver company, and what are they going to see? You don't even need me to name names. You know who they are, right? That's where that money will pile in. So if we're in that blow-off top phase, which I don't believe, but if you think that, then those majors, that's the obvious first and foremost place to invest. And by the way, our good friend Rick Rule, when he talked about taking profits in recent months, he also mentioned buying some of those blue chip names. So that's kind of interesting. But is it, can I say that they're a compelling value proposition? Well, maybe if you price them at $4,000 gold or $60 or $70 silver, sure. But that's not how the math works in this business. The standard practice, for good reason, because of volatility of nothing else, and because prices don't always go up, and because even if prices do continue going up, so do costs. Like if you're a gold miner, iron costs, steel costs, that's an expense for you. If you're an iron miner, you want to see iron prices go up. If you're a gold miner, you don't want to see iron prices go up, right? So you can't look at the current peak and say, oh, this company's cheap by this peak. You need to look at long-term averages. For example, life of mine. If this mine has 10 years of mine life left, well, what's the average gold price over 10 years? That's a much more conservative number. And people don't want conservative numbers. They want to hear it's going to the moon. That's maybe what you want to hear. But if you want to make money, you want to speculate or invest based on conservative numbers, right? And if you can't make a compelling case based on conservative numbers, sorry, but the truth is you're participating in the greater fool theory. You're buying high and hoping to sell higher. That's not buying low and selling high, which is the formula that, we all know and understand. So don't let the FOMO fool you. Volatility is your friend here. There's no need to chase 52-week highs or all-time highs, whether blue chips or any other of these stocks. There's always another kerfuffle. There's, the Fed doesn't cut when they think, and it doesn't really matter in our real world, but that can move spot prices and that can create buying opportunities.
The breakdown of monetary discipline has removed the automatic checks that once restrained excessive government spending. As systems move from nothing back towards something tangible, wealth transfer becomes unavoidable. Those who prepare can benefit from the transition, while those who remain passive risk being left behind. In inflationary melt-up environments, gold and silver tend to rise fastest, first becoming unaffordable and eventually difficult to source as physical demand overwhelms available supply. Silver's volatility is not a flaw but a feature of this phase. Sharp advances are often followed by consolidations that reset sentiment before the next leg higher. Physical shortages, paper-to-metal imbalances, and rising demand can temporarily distort price signals, but longer-term trends remain intact. Volatility creates opportunity for disciplined investors willing to accumulate on weakness rather than chase strength. What matters most is resisting fear of missing out and focusing on value rather than headlines. Bull markets reward patience, preparation, and selective positioning far more than emotional timing. Let's get back to the interview.
Late 79, the public changed their preference from gold to silver. The Hunt brothers were used as scapegoats, basically. They had such a concentrated position in silver that it was easy. And they got charmed by the leverage of margin toward the end. At first, there was a great article in Playboy magazine called Silverfinger. Where they had this shootout at the Circle K ranch, and the Circle K Cowboys, the best marksmen that the Hunt brothers had, went with them to New York, and 3 737s, or 727s back then, were used, and this was like midnight, in the middle of the night, with these cowboys guarding all the silver that they were taking delivery from the COMEX, and then they flew it to Switzerland. So they took delivery of physical bars. They honestly thought that the dollar was doomed because it had only been a fiat currency for just a few years at that point. And, throughout history, all fiat currencies have failed except for the ones that exist right now. And this experiment started in 1971. All the world's currencies used to be connected to gold through the US dollar under the Bretton Woods system. But to get back to your question, the gold-silver ratio, I don't think there's going to be any problem selling silver to buy gold. You may end up having to buy kilo bars instead of gold. There will be shortages on certain products, but you'll be able to, there will be so many people wanting the silver because of the performance of silver, and you have to be early, not late. I'd rather be years early than a day too late.
I do think that we're likely to see a period of consolidation, but I don't see that as a bad thing at all. If 4,000 is the next 2,000 for gold, after that big screaming rise up to 2,000 in 2020, we consolidated for 3 years. If that's the worst case scenario that we're looking at, that's not a bad scenario. And it's an excellent source of opportunities for anybody that missed it, right? If you're new to the gold and silver space, or monetary metals, as I prefer to call them, it's hard to chase something that just hit all-time highs, or at least nominal all-time highs. Whereas if we do get a period of consolidation, which is normal after a big move, right? Then that can be your very best friend if you're just coming to it. Silver, to hit an inflation-adjusted high, silver still has a long way to go. But come on, $60, $70 silver, it's never been there. I saw articles about triple-digit silver on CNBC, right? So I mean, this is happening now, and mainstream investors are getting an eyeful and an earful right now. If you have a company that is not responding to gold and silver prices in this market, there's something wrong with that company. I mean, the chances that you have found this one overlooked gem that nobody else noticed, and by the way, it's not just you or gold, like it's everybody that you noticed, and nobody else in the entire market appreciates this overlooked gem that you found, that's just very unlikely. As my friend Doug Casey used to say, the chances are slim to none and slim's out of town. So the answer to your question right now is that I'm not really seeing value opportunities in any particular class of these companies, whether it's majors, mid-tiers, or juniors. If there's something on sale now at these price levels, that is an absolute red flag. Why is this thing on sale? And maybe it's mispriced for some reason. Maybe there's a political scare that's overdone or something like that. But that's very, very rare. And it's probably not true, no matter what the PowerPoint says. But we don't have to buy today. Like there's always tomorrow. There's always the next fluctuation. So when I say I'm willing to buy a compelling value proposition today, I don't mean that I'm going to find something that's cheap today and do it right now. I mean, at this point, my outlook right now would justify if there is a big fluctuation, some scare in the gold space that's completely irrelevant, doesn't change the underlying fundamentals, and then something goes on sale, that would be of interest to me. Yeah, and so like juniors and so on, just mid-tier single asset, none of that matters. I don't think anything that has real merit is objectively cheap right now. But I would make a list of things like that, and if they got that way on some fluctuation, that would be of interest. One more thing on your single asset question, I wouldn't say necessarily cheap, but if something looks like not just an eventual slam dunk for a takeover, but maybe an imminent takeover, like they're getting close to that point where the vultures are circling and somebody needs to take this puppy over before the other guy gets it, you're not really looking at discount to NAV. The majors, that's not really what they're looking for when they buy. We've seen them pay, high premiums for companies. They're run by mostly bean counters, and that used to be an insult in my view, but not anymore. There's reasons why those companies are conservative, and once the boxes get ticked, this is a jurisdiction we can work with, it's a commodity we want, blah, 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 the size and the district, it's not just this mine, but the district. Once all those boxes get ticked, you can get a takeover offer, and really the spot market has no correlation with that at all. Timing those is not easy, but if you have something that's a screaming takeover target, then that might be something I might consider regardless of, the current market pricing.
This phase of the market reinforces the idea that attention, sentiment, and value do not peak at the same time. Rising mainstream coverage often marks awareness, not exhaustion, especially when prices are consolidating rather than collapsing. Periods of sideways movement after major advances are how long-term trends reset and create opportunity, particularly for those entering the space late but thinking long-term. At the same time, not everything deserves capital at elevated price levels. When strong metal prices fail to lift a company, that is usually a signal to step back rather than lean in. Real opportunities tend to emerge during dislocations, not during comfort. Discipline matters more than excitement, and patience often proves more profitable than chasing momentum at headline highs. This market continues to reward preparation, watch lists, and a willingness to wait for fluctuations that do not alter the bigger picture. That approach keeps optionality intact while avoiding the traps that form near emotional extremes. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.